Welcome to the Deep Dive, your ultimate shortcut to truly being well informed. Today, we're plunging into a topic that's fundamentally redefining the very essence of finance: the evolving role of data, specifically for commercial regional banks. For years, we've heard the phrase data is the new oil, suggesting it's a valuable commodity to be extracted and refined. But in today's dynamic financial world, that metaphor feels a bit, well, static, doesn't it? Our mission today is to unpack how data is becoming not just oil, but the literal currency of the financial world, and what this seismic shift means for regional banks and, maybe most importantly, for you, the customer. See, regional banks are currently facing immense pressure. We're talking incredibly agile fintech competitors, a mountain of ever-increasing regulations, and frankly, the burden of often outdated legacy systems. Data, it turns out, isn't just some helpful tool for them. It's becoming their primary lever for growth, for survival, and really for staying relevant in this rapidly changing market.
That's a really critical point you raise. This isn't merely a technological shift we're seeing. It's a fundamental business imperative for these institutions. It's becoming as vital to their day-to-day operation as, say, capital management or liquidity management. Today, we're going to explore how data underpins four core pillars of value for these banks. First, how it's revolutionizing customer relationships through hyper-personalization. Second, how it's used to fortify the balance sheet with much more sophisticated risk mitigation techniques. Third, we'll look at how it helps them navigate the complex regulatory maze more efficiently. And finally, how they're starting to pioneer the future with cutting-edge tools like generative AI. So it's really a comprehensive look at how banks can move beyond just collecting data to truly making it work for them and ultimately making it work better for you.
Okay, so let's unpack this shift you mentioned from data as the new oil. That new oil analogy, it was quite useful for a while, wasn't it? I mean, it really painted a picture.
It did. It helped frame the initial value proposition.
Right, you could see data as something valuable, something you could, extract from various sources, then refine, clean it up, process it, and finally monetize it, turn it into revenue. It really felt like a valuable raw material just sort of sitting there waiting to be exploited.
Yes, that analogy definitely served its purpose for a time.
Mm-hmm.
But as you said, it's fundamentally incomplete, and it's just too static for where we are now. The oil metaphor suggests, well, a finite resource, doesn't it? Something you extract and then use up.
Mm-hmm.
We think a far more accurate and dynamic framework today is data as the new currency.
Mm.
Just think about how a currency works.
Mm-hmm.
It's a medium of exchange, right? It circulates, in this case, in digital ecosystems.
Mm.
It enables transactions. And crucially, when it's well managed and connected, its value actually compounds.
Okay, so it's not just used up, it grows.
Precisely. This is exactly what's happening with data. A bank might offer you, say, a highly personalized financial service or a really tailored offer. That's the product. In exchange, they get your attention, your engagement, and that engagement, in turn, provides them with even more valuable data, which then fuels the powerful engines of AI and machine learning. So the data is constantly increasing its utility, generating more insights, becoming more valuable over time.
That makes sense. It's a cycle.
It is. And just consider the monumental global economic shift we've witnessed. Just a decade ago, the world's largest companies, they primarily made physical products or offered traditional services. Today, an astonishing half of the top 10 global companies are data-based platforms. Think Google, Amazon, Alibaba. That's a pretty stark illustration of this fundamental transformation, isn't it?
It really is, but here's where it gets really fascinating and, frankly, a bit paradoxical for a long time. Historically, we, the customers, we were the ones generating all this incredibly valuable data, right? Every click, every transaction, every interaction online.
Yes, the
Yeah.
source of the value.
But for all that valuable information we were providing, we often received very little tangible value in return. Our data was captured, it was aggregated, sold, resold, often just to target us with more advertising or, offers we didn't necessarily want or need. It felt like a profoundly one-sided exchange, like a transaction where only one party was really benefiting.
And that imbalance, that's precisely what's now being corrected by some powerful, market-altering regulatory forces. The Consumer Financial Protection Bureau, the CFPB, is a major driver of this shift, at least here in the U.S. Their personal financial data rights rule, for instance, is designed as a cornerstone of what we call open banking.
Open banking. We hear that term a lot. What does it practically mean for listeners?
Well, for you, the listener, open banking essentially means you gain explicit control and ownership over your financial data. You will soon have the power, legally mandated power, to securely share your data with other financial service providers you trust. You can revoke access whenever you want. You can even theoretically port your entire financial history to a competitor if you choose.
Wow, okay. That's a big deal.
It's huge. This isn't just some minor tweak. It fundamentally alters the power dynamic in finance. And this is exactly where the data as currency metaphor becomes quite literal. Banks that don't provide truly compelling personalized services, which, you could think of as the goods in this new transaction, they'll see customers simply take their valuable data currency elsewhere.
So customers vote with their data.
Exactly.
Yeah.
This leads to rapid customer churn if the bank isn't delivering value for that data. So, customer experience. It's no longer just a nice-to-have marketing objective. It's becoming the central mechanism for acquiring the raw data fuel needed to operate the entire banking enterprise. Without that continuous flow of consented data, the bank's engines, their analytics, their personalization, they simply run out of gas. Hashtag tag tag BB.
Yeah.
The regional bank's unique dilemma.
This new reality, it really puts regional banks at a difficult crossroads, doesn't it? They seem caught between some truly intense pressures. On one side, you have these mounting regulatory demands. They strain resources, they drive up compliance costs significantly. It's not a small burden, and it just seems to grow every year.
It's a constant challenge, absolutely. The compliance overhead is substantial.
Then there's this competitive asymmetry that's pretty wild when you look at it. Non-banked entities these days originate something like nearly 80% of residential loans, for example. And often, they don't face the same kind of stringent compliance burdens as traditional regulated banks. It creates a distinctly uneven playing field.
That's a major source of friction, yes. Different rules for different players in the same market.
And of course, the ever-present threat from the fintechs and the neobanks. These competitors are incredibly agile. They aren't encumbered by decades of legacy technology. They're built from the ground up on modern, data-centric architectures. It must feel like trying to compete in a speedboat race when you're piloting a supertanker, weighed down by all these complex, older systems.
It's a spot-on analogy. It really captures the challenge. In such a challenging and dynamic environment, strategically harnessing both internal and external data isn't just an option for these regional banks. It's truly the primary lever they have for differentiation, for resilience, and for sustainable growth. And look, this isn't just an academic theory. It's profoundly reflected in the real-world priorities of senior banking executives. Over the past few years, we've seen study after study showing them increasingly ranking data analysis and business intelligence as their absolute top investment areas.
So they know they have to do this.
They absolutely know. They understand that without mastering data, they simply cannot compete effectively, maybe not even survive long-term in this new financial landscape. It truly has become as fundamental as managing their capital. Hashtag HC. The 4 pillars of data-driven value. Introduction.
Okay, so what does this all mean for how banks actually operate day-to-day? How do they use this data?
We've identified 4 interdependent pillars that kind of form the framework for this deep dive. They show how a robust data strategy threads through each one, fundamentally changing how banks create value. First, we'll explore how they're revolutionizing the customer relationship. This is all about achieving customer primacy through hyper-personalization and proactive service.
Being really close to the customer, yeah.
Second, we'll look at how they are fortifying the balance sheet. This involves leveraging advanced analytics for much more sophisticated credit risk mitigation and portfolio management.
Protecting the core business.
Third, we'll discuss how they are navigating the regulatory maze, basically employing data intelligence to automate and streamline that burdensome compliance process, making it less painful, more efficient.
And finally, we'll dive into how they are pioneering the future with generative AI. Harnessing this next-generation AI to drive not just efficiency, but potentially profound innovation.
It's really crucial, though, to understand the deep interconnectedness of these pillars. They don't operate in isolation, in silos. They are intrinsically linked. A failure in one area, let's say, poor data quality within your customer systems, it doesn't just stay contained there.
Right, it spills over.
Exactly. It creates cascading risks across all the others. Imagine flawed customer data leading to inaccurate credit risk models. That, in turn, could result in non-compliant regulatory reporting down the line. The integrity and the accessibility of data, that's the common denominator for success across the entire enterprise. Without a solid data foundation, all these ambitious strategies, frankly, they just crumble. Hashtag Tag2. Revolutionizing the customer relationship through data intelligence.
Okay, let's dig into that first pillar. Revolutionizing the customer relationship. In an era where financial products are becoming increasingly commoditized, I mean, let's face it, one savings account looks a lot like another these days, and digital competition is just fiercely intense. The battleground for regional banks seems to be firmly in establishing what you called customer primacy.
That's the key term, yes.
And this is won or lost, it seems, entirely on a bank's ability to use data to transform that customer experience. It's about moving beyond just generic transactions to create a personalized, proactive, and continuous relationship, one that truly feels like it's built just for you.
That's absolutely the core challenge. Modern banking customers, especially younger generations, have incredibly high expectations now. They expect their financial institution to truly understand their unique needs, their specific financial situation, maybe even their life stage or goals. A generic one-size-fits-all approach, it just doesn't cut it anymore. In fact, it's a direct driver of attrition of customers leaving.
People will walk if they don't feel understood.
The data shows they will. We've seen figures suggesting a significant 53% of customers state they would switch providers if the services aren't personalized to them. This clearly mandates that banks must move beyond broad mass marketing towards true hyper-personalization. And the foundation for achieving this level of hyper-personalization, it's building a comprehensive 360-degree view of the customer.
The 360-degree view, what does that involve?
Well, it requires consolidating data from a multitude of sources. Think about internal data first. Transactional records from core systems, loans, deposits, payment cards, investments, interaction data from customer relationship management or CRM systems. That includes things like call logs, email correspondence, records of in-branch visits, and also detailed digital banking usage logs. What time do they log in? Which features in the app do they use most often?
Okay, so all the internal stuff.
Right. But then this internal data can be powerfully enriched with relevant external sources. Things like third-party market data, broader economic indicators relevant to the customer's region or industry, maybe even demographic information that helps segment and understand different customer groups better. It's really about pulling all those different threads together into a single, cohesive, actionable picture of each customer.
Okay, so once a bank has this unified 360-degree data profile, what can they actually do with it? What are some of the most impactful things they can do for us, the customers? What does hyper-personalization truly look like in practice beyond just, buzzwords?
That's where it gets really exciting because this unified view enables a whole range of high-impact personalized actions that deliver tangible value directly to you. First, imagine truly tailored product recommendations. And I mean going far beyond simplistic cross-selling like you have a checking account, want a credit card.
Yeah, that gets old fast.
Right. We're talking about precise, timely offers based on inferred needs or life events. For example, a bank might analyze spending patterns and proactively offer a mortgage product to a customer whose data suggests they might be expecting a child or looking to upsize their home. Or perhaps offer a debt consolidation loan to someone showing early signs of financial stress, like maybe increased reliance on high-interest credit cards. It's about being there with the right solution at the exact right moment in your financial life.
So it's anticipating needs, not just reacting, almost like being a financial GPS rather than just a bank.
Precisely. That's a great way to put it. And that leads directly to the second key area, proactive financial wellness insights. Instead of just processing transactions passively, banks can use data to truly act as financial coaches for their customers. Advanced analytics can identify potential cash flow issues before they actually occur. They can flag unusual or potentially duplicate charges automatically. They can even provide helpful context by comparing your spending in a specific category, say dining out to anonymized peer groups, maybe gently nudging you towards better financial habits.
That could be really useful. Or maybe slightly scary, depending on the category.
Laughs slightly. Potentially. But the goal is helpfulness. Huntington National Bank's Heads Up feature is a prime example of this in action. It proactively surfaces alerts about things like upcoming low balances or large pending debits and provides specific recommendations. It's turning raw data into actionable guidance for the customer.
That sounds incredibly useful. No more nasty surprises when you check your balance after the weekend.
Exactly. And finally, the third area is customized communication. Data allows banks to tailor not just the message content, but also the tone and even the channel of communication to your individual preferences. This means you get information that's actually relevant to you, delivered in the way you prefer to receive it, whether that's an alert in the banking app, a personalized email, or maybe even a proactive call from your relationship manager for more complex matters. One bank, in fact, found that implementing this level of personalized financial guidance led to a measurable 10-point increase in customer satisfaction scores. And impressively, it also correlated with customers holding larger relationship balances overall, likely because they felt truly understood and valued by their bank. #MEB. the central role of CRM and integrated platforms. Now, this profound level of personalization we're discussing doesn't just happen by magic, of course. It's enabled primarily by a modern customer relationship management or CRM platform. You can think of this CRM as the central nervous system, the hub for all customer data interactions.
But isn't the big challenge for many regional banks those old legacy systems we mentioned? Don't they create data silos?
That is the significant challenge, yes. Legacy systems, often built up over decades for specific products or functions, frequently create these fragmented data silos. One system holds loan data, another holds deposit data, another tracks branch interactions, and they often don't talk to each other easily. This makes achieving that truly holistic 360-degree customer view virtually impossible.
So how does a modern CRM fix that?
The solution is that a modern CRM system is designed specifically to break down these silos. It acts as an integration layer, pulling together data from these disparate sources, core banking systems, digital channels, even third-party sources to provide a single, reliable source of truth for every customer. This unified view is accessible to every relationship manager, every service agent, no matter which channel the customer interacts through.
And that empowers the employees, I imagine.
It fundamentally empowers employees. By consolidating the bank's internal transactional and interaction data, and then enriching it with valuable third-party data, think comprehensive business information from sources like Bloomberg or UCC filings, which provide insights into things like legal actions or commercial data. By putting all of that into user-friendly dashboards, relationship managers can suddenly, very quickly, identify prospective clients, understand existing client needs much more deeply, and make incredibly informed decisions on the spot. They're not spending hours manually sifting through 10 different reports trying to piece the picture together.
Saving them a ton of time and effort.
Exactly. This directly accelerates sales cycles because they can act on opportunities faster. And it significantly enhances overall business growth. It's really about turning all that fragmented data into actionable intelligence right at the point of customer interaction.
And the best part is these benefits aren't just, theoretical or fuzzy. They sound tangible and measurable. Are banks seeing real returns?
Absolutely. We've seen compelling evidence of significant quantifiable returns on these investments. Consider a case study of a mid-sized regional bank that implemented a comprehensive personalization strategy. This included things like AI-powered spending insights delivered through their mobile app, personalized next best action recommendations surfaced to their financial advisors, and highly targeted email communications based on customer behavior. Within just the first year of rolling this out, they achieved a remarkable 22% increase in mobile app engagement.
Wow, 22%.
Yes, and 18% growth in the adoption of new products offered through these personalized channels. And critically, a substantial 13% reduction in customer attrition, in churn. Another large national bank saw similar success. They used predictive analytics specifically to identify customers who were at high risk of leaving the bank. By intervening proactively with targeted retention offers or service improvements, they achieved a significant reduction in attrition, which in turn accelerated their overall business growth and demonstrably heightened customer satisfaction scores.
So these outcomes really underscore that investing in personalization isn't just a marketing cost. It's a direct driver of core business metrics like revenue and retention. It moves way beyond just marketing fluff into real business impact.
That's exactly right. But what's truly fascinating here, and perhaps less obvious, is that this personalization isn't just a marketing or customer service function. It's also becoming a powerful, frontline risk mitigation strategy.
Risk mitigation. How does better customer service reduce risk?
Well, traditionally, customer service and risk management have been viewed as completely separate domains within a bank, right? But proactive, data-driven personalization creates a direct causal link between them. Let's start with something as seemingly simple as data quality in transaction descriptions. When the merchant data in your online statement is unclear or cryptic, just a string of numbers and letters, customers often call the bank to dispute charges they simply don't recognize.
Oh yeah, I've done that. What is ACME Corp ZYX123?
Exactly. And each of those calls increases the bank's call center operational costs. More importantly, it erodes customer trust if it happens frequently. Now, a personalization engine fed with good data can proactively address this. It can maybe flag transactions from new or unfamiliar vendors with a simple automated alert in the app like, "We see a new charge from merchant name. Does this look right?" Click yes or no. This prevents confusion before it even starts, significantly reducing those costly service calls and improving the experience.
Okay, that makes sense for operational risk. What about credit risk?
That's where it gets more profound. Advanced analytics, Looking at that 360-degree view can often identify customers who are potentially heading towards financial distress. Think about subtle pattern changes, maybe dwindling balances just before their next paycheck consistently, or an increasing reliance on high-interest debt like credit cards or payday loans. Now, the traditional reactive banking model would simply wait for the customer to overdraft their account, maybe miss a payment, and then hit them with a fee.
Right, which feels punitive and doesn't really help them.
Precisely. It's a negative interaction, it damages the relationship, and it might ultimately lead to a credit loss for bank anyway if the customer defaults. However, a proactive, data-driven model identifies this risk early. And instead of waiting for the negative event, it intervenes with a helpful solution. Maybe it's just a timely alert about a potential low balance coming up. Or perhaps it's a proactive offer for a small, manageable line of credit to bridge a gap, or information about debt consolidation options, or even an automated savings program to help build a buffer. This transforms the potential credit loss event into a positive, trust-building engagement. The bank simultaneously mitigates a potential loss, strengthens the customer relationship by showing they care, and potentially even generates new healthy revenue through a suitable product offer.
So it's a win-win-win. Lower risk, happier customer, maybe even new business.
Exactly. And this fundamentally reframes how banks should view investments in personalization platforms and advanced CRMs. They are not merely customer experience expenses. They are core components of the bank's modern risk management framework. And the ROI calculation absolutely must include the value of avoided credit losses and reduced operational costs from fewer service calls and disputes. It's a much broader value proposition.
Okay, so we've seen how data is transforming the front office, how banks connect with and serve customers in new ways. But what about the very foundation of banking managing risk and ensuring the balance sheet stays rock solid? Does data play an equally transformative role there?
We're talking about the bedrock of any regional bank stability, its loan portfolio. Traditionally, loan underwriting relied heavily on, well, pretty static FICO scores and historical financial data, right? It was very much a look in the rearview mirror. That's a perceptive question, and the answer is a resounding yes. This is arguably one of the most critical areas where data and advanced analytics are fundamentally reshaping how banks manage credit risk. We're seeing a clear shift from that static historical assessment you described to a much more dynamic, forward-looking discipline. And honestly, mastering this evolution is absolutely paramount for long-term profitability and resilience, especially given the economic uncertainties we often face.
So how are they moving beyond just FICO and old tax returns?
Well, forward-thinking lenders are now actively integrating a much richer tapestry of alternative data sources. They're doing this to build a more accurate and crucially more timely picture of a borrower's true creditworthiness. For example, one major area is cash flow analysis. This was really pioneered by fintech lenders, but traditional banks are catching up fast. Instead of just looking at a credit report snapshot, this analyzes the actual flow of money into and out of a borrower's bank accounts over time. This provides a near real-time view of their income stability, their spending habits, their overall financial health buffer. And this can be significantly more predictive of their actual ability to repay a loan than just a historical credit report.
Okay, looking at actual money movements makes sense. What else?
Another important one is the incorporation of alternative payment histories. Think about things like consistent on-time rental payments or utility bill payments. Historically, these didn't really factor into credit scores in a major way. But paying your rent and keeping the lights on consistently is a pretty strong indicator of financial responsibility, isn't it?
Absolutely, especially if someone doesn't have much traditional credit history.
Exactly. This is transformative, especially for assessing the credit risk of individuals who might have thin or even non-existent traditional credit files, maybe young people, recent immigrants, or those who primarily use cash. By incorporating this data, banks can expand access to mortgages and other loans for previously underserved populations. And this isn't just niche. We're seeing major players like Fannie Mae and Freddie Mac starting to integrate these alternative data points into their automated underwriting systems. It's becoming mainstream.
That's great for financial inclusion, too. What about for business loans, commercial clients?
For commercial clients, the trend is towards building a comprehensive entity view. This means accessing and integrating a wide array of both structured data, like financial statements, and unstructured data. Unstructured data could include things like detailed information on complex corporate ownership structures, real-time news alerts for any adverse media about a company or its key executives, and independent ratings and scores from various providers. The key here is delivering all this disparate data in a structured, standardized format. That's what enables underwriters to consume it quickly and dramatically increases the speed and efficiency of commercial lending decisions. #TB. Predictive analytics and portfolio management.
Okay, so the data going into the decision is much richer, but you mentioned moving from static assessment to ongoing dynamic management of the entire loan portfolio. It sounds like the most significant transformation here, probably powered by AI and machine learning, is this shift from reactive monitoring, waiting for problems, to truly predictive analytics. That sounds like a potential game changer for risk.
It absolutely is. This shift allows banks to anticipate and mitigate credit risk proactively, rather than simply reacting to losses after they've already occurred when options are limited.
Huh.
Let's consider early warning systems. Traditional risk management often relies on lagging indicators, right? Like a loan becoming 30, 60, or 90 days past due. By then, the problem is already well established.
Yeah, the horse is bolted by then.
Exactly. In stark contrast, modern predictive models act as genuine early warning systems. They continuously analyze vast streams of real-time data, looking for subtle changes in a borrower's transaction behavior, maybe a sudden spike in credit utilization across different cards, even factoring in external macroeconomic signals relevant to that borrower's industry or region. These models can detect subtle signs of deteriorating credit quality long before a borrower actually defaults on a payment. To give you a sense of the power here, one U.S. commercial lender implemented an AML solution for portfolio monitoring that could predict which customers were likely to become delinquent with an impressive 93% accuracy months in advance.
93% accuracy months ahead, that gives them a lot of time to act.
A huge amount of time.
Mhm.
And this capability also leads to dynamic risk scoring. Instead of relying on a static FICO score that might be updated once a year or maybe quarterly, AI-driven models can continuously update a borrower's risk profile based on their real-time financial behavior and circumstances. This allows the bank to make dynamic adjustments. Maybe they slightly reduce a credit line if risk appears to be increasing, or more constructively, they can proactively reach out with intervention options, like tailored loan modifications or restructuring plans, when those early signs of distress are detected. It's personalized risk management.
And what about looking at the big picture, the whole portfolio under stress?
That's the third key area, advanced stress testing. Modern analytics platforms enable banks to conduct highly sophisticated stress tests on their entire loan book. They can simulate the impact of various adverse economic scenarios, things like sharp increases in interest rates, severe regional economic downturns, or shocks specific to certain industries where they have high exposure, like commercial real estate, for example. This helps the bank identify hidden vulnerabilities within the portfolio, concentrations of risk they might not have seen otherwise, and crucially, ensure they have adequate capital reserves to withstand significant duress. It's about building resilience. #SHMAFI, operational efficiency, and the competitive moat. Now, beyond just improving the accuracy of risk assessment, these data-driven approaches also yield significant operational benefits for the bank itself. By merging all this diverse financial data, non-financial information, behavioral scoring, etc., into automated decision engines, banks can dramatically speed up the credit approval process.
Faster loan approvals. Customers would like that.
Absolutely.
Yeah.
Faster decisions, but also more consistent ones. Automation reduces the need for time-consuming manual reviews, which lowers operational costs. And importantly, it helps to combat the potential for human error or even unconscious bias that can sometimes creep into subjective lending decisions. But the prerequisite for achieving this level of automation and speed is the seamless integration of data from all those disparate systems we talked about, the loan origination system, the CRM, various risk databases, into a single, consistent platform or data layer.
That integration challenge again.
It's always central.
Mhm.
And this trend toward data unification and advanced analytics is actually creating a new kind of competitive moat in banking. Leading-edge risk management is no longer about analyzing credit risk, market risk, and operational risk in separate, disconnected silos. It's about integrating them into a single, unified framework for a holistic view of risk.
Can you give an example of how that integrated view changes a decision?
Sure, let's take a commercial real estate loan application. A traditional bank might assess it primarily based on the property's historical financial performance and maybe the borrower's personal FICO score. Standard stuff. A data-driven bank, however, does all of that, but also integrates real-time data feeds. Maybe data on current office vacancy rates in that specific neighborhood or submarket, maybe automated news alerts flag potential merger and acquisition activity involving the borrower's parent company, which could change the risk profile. Maybe they pull in alternative data on the borrowing entity's other financial behaviors like payment patterns to key suppliers. Suddenly, you have a far more nuanced and predictive assessment of the total risk associated with that loan. A loan might appear perfectly sound based on its own isolated metrics, but that integrated external data could reveal a looming threat. Maybe a major tenant is leaving, or the local market is softening rapidly that would otherwise be completely missed.
Allowing the bank to maybe adjust terms, increase reserves, or even decline the loan to avoid a future loss.
Precisely. But this sophisticated capability is entirely dependent on having a modern data architecture in place, typically something like a centralized data warehouse or, increasingly, a cloud-based data lakehouse. These architectures are designed to ingest, clean, standardize, and analyze diverse data types, structured and unstructured, in near real time. Banks that successfully build this capability can price their risk much more accurately. They can avoid unexpected losses from risks they didn't see coming. And they can confidently pursue good lending opportunities that less sophisticated competitors might simply have to pass on because they can't accurately assess the risk.
So it becomes a real competitive advantage.
A significant one. Which is why the investment in data architecture isn't just an IT expense. It's a direct investment in the bank's core risk-bearing capacity. And the ROI. It's measured directly in things like improved portfolio quality, enhanced capital adequacy ratios, which regulators love, and a significant reduction in loan loss provisions. Studies suggest potentially 30–40% lower provisions for banks that effectively deploy advanced predictive analytics compared to those relying on older methods.
That's a huge difference. So just to quickly bring it all together, the contrast between the traditional and the modern data-driven approach to credit risk is quite stark, isn't it? When it comes to underwriting data, we've gone from just historical FICO and basic financials to integrating that with real-time cash flow, alternative payments like rent and utilities, and other non-traditional data sources.
Right, a much richer picture.
For risk assessment, it's moved from static, point-in-time historical reviews to dynamic, continuous assessments using powerful predictive models that learn and adapt.
Forward-looking, not just rear-view mirror.
Portfolio monitoring has evolved from being reactive, basically, waiting for delinquencies to pop up, to being truly proactive, with these advanced early warning systems flagging potential issues months ahead.
Anticipating, not just reacting.
The decision speed has shifted dramatically from slow, often manual processes measured in days or weeks to potentially fast, automated engines giving decisions in minutes or hours for simpler credits.
Speed matters in a competitive market.
And finally, the data sources themselves have expanded from primarily internal data silos and the major credit bureaus to this unified framework, merging internal CRM and transaction data with diverse external signals, market data, news alerts, maybe even environmental, social, and governance, or ESG data becoming relevant for certain sectors. It's a complete overhaul of how risk is understood and managed.
It really is a paradigm shift in managing the core risk of banking. Hashtag RJ5E. Navigating the regulatory maze with data intelligence.
Okay, let's shift gears now and talk about the elephant in the room for probably every regional bank executive, regulatory compliance. It's not just a non-negotiable reality. It's an incredibly high-stakes one. Compliance represents a huge cost center, a major drain on resources, and a significant source of both operational and reputational risk if you get it wrong.
Absolutely. The penalties for non-compliance can be severe, and the reputational damage even worse.
And it feels like the traditional, often manual approach to compliance, armies of people checking spreadsheets and reports, is just becoming increasingly unsustainable. The volume of data is exploding and the complexity of the rules just keeps growing.
You've hit the nail on the head. What's fascinating, though, is that when you peel back the layers, at their core, almost all major banking regulations are fundamentally data challenges. Effective compliance, really. It hinges entirely on a bank's ability to collect, manage, analyze, and report on vast quantities of data accurately, consistently, and in a timely manner. Just think about some key areas. Anti-money laundering and the Bank Secrecy Act, AML/BSA compliance, for example. This requires monitoring immense volumes of real-time transaction data across the entire customer base, looking for suspicious patterns that might indicate money laundering or terrorist financing. You simply cannot do this effectively manually anymore. It absolutely necessitates sophisticated analytics and automated systems for detecting anomalies and filing the required suspicious activity reports, or SARs.
Okay, AML is a big one. What else?
Then there's fair lending and consumer protection regulations, things like the Equal Credit Opportunity Act, ECOA, or the Truth in Lending Act, TILA. To comply here, Banks must use advanced analytics to monitor their lending decisions, both automated and human, for any signs of potential discrimination, ensuring equitable access to credit across different demographic groups. They also need incredibly robust systems to manage and verify the accuracy of all the customer disclosures required by law, making sure you, the customer, know exactly what you're signing up for clearly and accurately.
Right, making sure the playing field is level and transparent.
Exactly. And of course, a huge area now is data privacy and security regulations. Think about the Gramm-Leach-Bliley Act, GLBA, federally, but also the growing patchwork of state laws like the California Consumer Privacy Act, CCPA, and even international regulations like GDPR if the bank has overseas customers or operations. These mandate stringent controls over how customer data is collected, stored, used, and protected. We're talking requirements for data encryption, strong access governance, who can see what data, secure processing environments, and the ability to respond swiftly and accurately to customer requests about their data, like requests for deletion or access.
That sounds incredibly complex to manage across the board.
It is. And finally, for larger and more systemically important institutions, there are regulations like BCBS 239, which focuses specifically on principles for effective risk data aggregation and reporting. This places direct regulatory scrutiny on the quality, the integrity, and the timeliness of a bank's risk data aggregation capabilities. It effectively elevates data governance from being just an IT concern to a critical board-level responsibility. It dictates precisely how banks must collect, manage, and report their risk data to regulators. ###B, automating compliance for efficiency and accuracy.
It's crystal clear that trying to manage all of this with manual processes is just slow, incredibly labor-intensive, and frankly just plain prone to human error. That sounds like a recipe for disaster in such a high-stakes environment where one mistake, one missed filing, can lead to massive fines or serious reputational damage.
Indeed. The risks of manual compliance are simply becoming too high, and the costs too burdensome. This is where modern compliance platforms leveraging technology come into play. They are designed specifically to automate these critical functions, dramatically improving both the efficiency and the accuracy of compliance processes. For instance, we're seeing widespread adoption of AI-powered monitoring for things like AML and fraud detection. AI-driven systems can automatically screen literally millions of transactions in near real time, comparing them against complex rules, historical patterns, and sophisticated behavioral models. They can flag potentially suspicious activity, potential money laundering, potential fraud with far greater precision and speed than any team of human reviewers could ever achieve. This allows compliance teams to focus their expertise on investigating the highest risk alerts rather than drowning in false positives.
So AI helps find the needles in the haystack.
A much better way to find them, yes. Then there's the power of centralized audit trails. Modern compliance platforms consolidate all compliance-related data, activities, policy changes, investigation notes, everything into a single central repository. And critically, they create immutable automated audit trails. This means there's a permanent, unalterable record of everything that happened, who did it, and when. This ensures that the bank is perpetually ready for regulatory examinations, eliminating that frantic, last-minute scramble for documents and data that often precedes an audit. It saves immense time, cost, and stress.
Being audit-ready all the time must be a huge relief.
It's a game changer for compliance departments. And another crucial area is automated regulatory change management. The regulatory landscape is constantly shifting new rules, new guidance, amendments. Keeping track manually is a nightmare. Now, AI tools can be programmed to automatically scan pending legislation, propose rules from regulators, and new official guidance documents as soon as they're published. They can then automatically compare these updates to the bank's existing internal policies and procedures to quickly identify potential gaps or conflicts. This flags necessary changes much earlier, assigns tasks for updates, and significantly minimizes the risk of non-compliance simply due to oversight or delay in reacting to a new requirement. It helps banks stay ahead of the curve. ###C. The strategic impact of open banking on compliance and data governance.
Let's loop back quickly to open banking, which you introduced earlier. We talked about customer control, but thinking about it from a compliance perspective. That CFPB rule mandating data access, it isn't just about customer convenience, is it? It introduces entirely new compliance obligations for banks, right?
That's a really important distinction to make, yes. The rule isn't just suggesting banks share data. It mandates that they must provide customers with direct control over their financial data. This includes the technical ability to securely share that data with third-party financial apps or service providers that the customer authorizes. And crucially, this sharing must happen via secure, standardized APIs, those application programming interfaces we mentioned.
APIs being like secure digital pipes for data.
Exactly. APIs act like standardized digital pathways that allow different software systems, the bank system and the third-party app system, to talk to each other securely and directly, based on the customer's explicit consent. This move is specifically designed to transition the industry away from older, less secure practices like screen scraping.
Screen scraping. That's where the third-party app basically logs into your bank account as using your credentials.
Correct. The third-party app effectively reads your bank's website display or mobile app screen to gather your data. It's far less secure because you have to share your actual bank login credentials with the third party. It's also unreliable because if the bank changes its website layout, the screen scraping breaks. The move to APIs mandated by open banking rules requires significant new investments by banks in the underlying technology. They need robust systems for managing customer consent, recording who you've given permission to for what data and for how long. And they need to ensure the data is shared via secure, standardized authentication protocols like OAuth 2.0. OAuth acts like a trusted digital handshake, granting temporary specific access to the third party without the customer ever having to share their actual bank login password.
Okay, so it's a big technical lift, but it sounds much more secure and controlled for the customer.
It is. But think about the implications. It requires a whole new level of data management and security infrastructure. And the common thread weaving through all of these strategic initiatives we've discussed, whether it's improving risk management, ensuring regulatory compliance, driving customer personalization, or enabling open banking, is the absolute necessity of robust data governance.
Data governance seems to be the bedrock for everything else.
It is the foundational layer. Without strong data governance, everything else falters or fails. Let's consider a concrete scenario to illustrate why. Imagine a regional bank wants to launch a new, innovative, highly personalized lending product using advanced AI analytics. To make this work, the risk management function needs access to complete, timely, accurate, and high-quality customer data. This is essential for building reliable risk models that are not only predictive of default, but also free from biases that could lead to discriminatory outcomes, violating fair lending laws. Simultaneously, the compliance function must ensure that the collection, storage, and use of all this customer data strictly adheres to all applicable fair lending regulations, privacy laws, and consumer protection rules.
So risk needs good data. Compliance needs compliant data use.
Precisely. Therefore, before the first line of code for the new product's fancy AI model can even be written, a robust data governance framework must already be in place and operational. This framework is responsible for defining critical things like who owns specific data sets within the bank, what are the minimum acceptable data quality standards, what is the documented data lineage, where did this data come from, how has it been transformed or combined, and who has permission to access and use this data for what specific purposes. Without this governance structure firmly in place, the project is almost certainly destined to fail. The risk models built on poor or incomplete data will be unreliable. The compliance department will likely block the product launch due to unacceptable regulatory exposure, and the promising business opportunity will simply evaporate.
So bad data governance kills innovation.
It's a primary killer. And this is not just a hypothetical problem. We saw that survey where a staggering 92% of banking respondents cited delays in just retrieving the data they needed, and 81% cited data quality issues as major roadblocks preventing them from moving forward with critical data initiatives. This clearly demonstrates that data governance is not some bureaucratic back-office function just creating red tape. When done right, it is the primary enabler of business agility and innovation in a data-driven world. So for a regional bank's board and executive leadership team, this means that funding for data governance initiatives, things like data catalogs, quality monitoring tools, master data management, should not be viewed merely as a compliance cost or overhead. It should be viewed as a critical, strategic investment that unlocks the potential ROI of all other technology spending across the bank. The ROI of data governance is effectively the sum total of the ROI of all the valuable business projects it makes possible.
Okay, let's move to the final pillar now and talk about the absolute cutting edge, generative AI, or Gen AI. We hear so much about ChatGPT and similar tools. It's clearly not a standalone solution that will magically solve all of banking's problems, but it certainly seems like an incredibly powerful accelerator for human capabilities and task automation across the entire banking value chain. How are banks really thinking about using this powerful new technology?
That's right. Gen AI is definitely the next frontier, and for regional banks, it offers a tantalizing path to truly enhance productivity, potentially much deeper customer engagement, and even more sophisticated approaches to risk management. But, and this is a crucial but, we need to keep emphasizing its ultimate impact, its real value, is entirely dependent on the quality, the accessibility, and the governance of the bank's underlying data. Without good, clean, well-understood data to learn from, Gen AI models can be unreliable, or worse, confidently wrong.
Garbage in, garbage out, but maybe fancier garbage.
Slight chuckle. That's one way to put it. The potential upside is huge, though. Accenture, for example, projects a potential productivity improvement of somewhere between 22% and 30% for early adopters of Gen AI in banking over just the next 3 years. That's a massive shift in how work could get done.
20 to 30%. That's significant. Where are the key applications in core operations?
We're seeing several key areas emerge. First, document intelligence. Banks deal with mountains of documents, loan applications, legal contracts, identification documents like passports, financial statements. Gen AI can automate the extraction, the interpretation, and even the initial verification of critical data points from these often dense and complex documents. This dramatically reduces manual data entry effort, minimizes human errors, and significantly accelerates end-to-end processes like customer onboarding or loan origination. It can cut down tasks that took days or even weeks into minutes or hours.
Okay, tackling the paperwork mountain. What else?
Second, code generation and modernization. This is a really interesting one. Gen AI can act as a co-pilot for the bank's software developers. It can significantly accelerate the migration of legacy code, for instance, helping translate old COBOL or SAS code, which are notoriously complex and have a shrinking pool of specialized experts available to maintain them, into modern languages like Python. It can also help generate new code for things like building risk models, writing automated compliance checks, or developing new features for customer-facing applications. This directly helps banks address the challenge of maintaining their aging systems and dealing with talent shortages in specialized areas.
So helping the tech teams build and modernize faster.
Exactly. And third, automated reporting and summarization. Think about how much time highly skilled analysts currently spend on routine reporting and writing tasks. Gen AI excels at automatically generating accurate first drafts of complex documents. This could include summarizing lengthy earnings call transcripts, drafting detailed credit risk memos based on underlying data, or even preparing initial drafts of suspicious activity reports, SARs, for compliance review. This frees up the human experts to focus their valuable time on higher-level analysis, strategic judgment, and decision-making, rather than getting bogged down in the rote writing process. #B, transforming customer and employee experiences with Gen AI.
This is where Gen AI gets really exciting, I think, for us as customers, and maybe even for the bank's own employees. It feels like it has the potential to reverse that often impersonal, sometimes frustrating nature of purely digital banking by enabling incredibly human-like interactions, but doing it at massive scale.
Absolutely. What's truly fascinating here is the potential evolution to next-generation customer service. AI-powered chatbots and virtual agents are rapidly moving far beyond the simple, often rigid, rule-based responses we're used to. Gen AI enables much more natural, conversational, and context-aware interactions. These advanced systems can remember your past conversations, understand nuance, handle more complex queries that previously required a human, and provide consistent 24/7 support. This can significantly increase call deflection rates, meaning fewer routine calls need to go to human agents, freeing them up for more complex issues, and it has the potential to greatly improve overall customer satisfaction. Imagine getting sophisticated financial advice or help resolving an issue from a virtual assistant that truly understands your history and communicates naturally.
A chatbot that's actually helpful? That would be nice.
That's the goal. But it's not just for customers, it's also about employee augmentation. Gen AI is emerging as an incredibly powerful tool for the bank's own staff as well. We're seeing agent assist tools, for example. These listen in on customer calls, with appropriate disclosures, of course, and provide real-time suggestions, relevant knowledge-based articles, or next-step guidance directly to the human service representative. This can significantly improve first call resolution rates by ensuring the agent has the right answer or process instantly at their fingertips. Gen AI can also be used to create highly personalized training modules for employees tailored based on their specific performance data or identified knowledge gaps. And it can serve as an interactive conversational knowledge base for navigating complex internal policies and procedures, making it much easier and faster for staff to find accurate answers when they need them. #C. Enhancing risk management and compliance with Gen AI. Gen AI also introduces some sophisticated new capabilities directly into the risk management and compliance toolkit, potentially taking accuracy and efficiency to another level beyond traditional analytics. One of the most powerful and maybe slightly counterintuitive applications is synthetic data generation.
Synthetic data, you mean fake data? How does that help?
It sounds odd, but yes, it's essentially fake but highly realistic data. Gen AI can learn the statistical patterns of real financial data, including rare events like complex fraud schemes. It can then generate large volumes of realistic artificial data sets of, say, fraudulent transactions or specific types of money laundering activities. This is incredibly valuable because real fraud data is often scarce, sensitive, and difficult to obtain in sufficient quantities for training robust detection models. Using synthetic data allows banks to train and rigorously test their fraud detection models on a much larger and more diverse scale, and critically, without ever having to use sensitive, real customer data for that training process.
Ah, okay. So you can test your defenses against realistic attacks without risking real data.
Precisely. We also see potential in advanced risk detection. By training on truly vast and diverse data sets, internal data, external data, news feeds, regulatory filings, Gen AI models may be able to identify novel, highly complex, and evolving fraud patterns that traditional rule-based systems, which rely on humans defining specific if-then rules, would completely miss. Gen AI's pattern recognition capabilities are just much more sophisticated. It can also be used to accelerate the end-to-end credit process we discussed earlier. Imagine a Gen AI tool summarizing vast amounts of structured and unstructured information about a commercial borrower, internal notes, call reports, news articles, public filings to provide a concise summary for the underwriter, or even generating a first draft risk assessment document for the loan committee's review.
Okay, it really sounds like Gen AI has the potential to be a game changer across many areas of the bank. But you've mentioned this crucial point repeatedly. The success of every single Gen AI use case depends entirely on having a strong data foundation. Why is that so absolutely essential for this specific technology?
It's simple, really, but absolutely critical. Gen AI models are only as good, only as accurate, only as reliable as the data they are trained on. They need access to massive volumes of high-quality, clean, well-governed, and easily accessible data to learn effectively. A significant risk inherent in Gen AI is something researchers call hallucination.
Hallucination like the AI is dreaming.
Sort of. It's where the model generates output that sounds plausible, maybe even authoritative, but is factually incorrect or completely nonsensical. And this risk of hallucination is dramatically amplified when the AI is fed incomplete, inconsistent, biased, or just plain poor quality source data. If the data it learns from is flawed, its generated output is far more likely to be flawed too. Therefore, attempting to scale Gen AI across a banking enterprise in any meaningful way is virtually impossible without having a modern technology stack in place. This includes things like cloud-based systems to provide the massive, scalable computing power Gen AI requires. It needs robust APIs for seamless data exchange between different systems. And fundamentally, it needs a data architecture like that lakehouse concept that can effortlessly handle both structured data, like numbers and spreadsheets, and unstructured data, like text from documents, emails, or call transcripts. Because Gen AI thrives on diverse data types. Legacy systems, unfortunately, with their data silos and inflexibility, are a major impediment to effective Gen AI adoption. They simply can't feed the beast properly.
So the infrastructure has to be ready first.
Absolutely. And this technological shift also represents a deeper paradigm change in how we even think about data analytics. Traditional data analytics and most machine learning techniques are primarily analytical. Their main job is to find patterns in, classify, or make predictions from existing data. They analyze what's already there. But Gen AI is fundamentally synthetic. Its core capability is to create new, original content, whether that's text, code, images, summaries, or even synthetic data itself based on the patterns and structures it has learned from the input data.
Can you give an example of that difference, analysis versus synthesis?
Sure. Think about credit risk again. A traditional risk model analyzes historical loan data to predict a probability of default for a new applicant. That's analytical. A Gen AI-powered risk workflow, however, might do that prediction, but then also synthesize a first draft of the credit memo summarizing the applicant's entire profile, generate Python code to run a specific stress test scenario requested by the underwriter, and draft a concise summary paragraph of the key findings for the loan committee report. It's creating new content. Or consider marketing. A traditional marketing analytics tool might identify a segment of customers likely to churn based on historical data. That's analysis. A Gen AI tool could do that identification and then go on to generate 3 distinct versions of a personalized email campaign, perhaps with different tones or emphasizing different benefits, specifically tailored to that churn-prone segment's known behaviors and preferences. It's generating the campaign content.
Okay, I see the difference. Gen AI is a creator, not just an analyzer. What are the implications of that?
The implications are profound. It means data is no longer just an input for human analysis and decision-making. It becomes the direct raw material for automated content creation and action. This points towards a future where many routine first draft tasks, content generation tasks, and even simple coding tasks might be largely automated by Gen AI. This could free up human employees to focus on higher value activities like strategy, complex problem solving, nuanced judgment, and building customer relationships, what proponents call the augmentation effect, where AI handles the routine stuff, augmenting human capabilities. However, this power also introduces significant new risks, particularly at scale. If the underlying data fed to the Gen AI is flawed, biased, or incomplete, the synthesized output, whether that's a compliance report, a customer communication generated code, or a risk assessment, will likely also be flawed. But now that flawed output can be generated and potentially distributed at a speed and scale that makes errors incredibly difficult to detect and contain before they cause damage. This elevates the need for robust data governance, rigorous model validation, and strong human-in-the-loop oversight, from being just best practices to being absolute non-negotiable necessities when deploying Gen AI in critical banking functions. The potential for scaled-up mistakes is simply too high otherwise.
Okay, so it's incredibly clear that achieving this vision of a truly data-driven regional bank isn't just about buying and plugging in some fancy new technology. It really demands fundamental shifts in strategy, in the bank's culture, and in its core operations. It sounds like there are some pretty deep-seated foundational challenges that regional banks really need to confront head-on if they want to succeed here. What are the biggest hurdles they face?
You're absolutely right. Success in this data-driven era is frankly impossible without directly addressing these systemic issues that unfortunately plague many traditional financial institutions. First, and perhaps the biggest technical challenge, is modernizing those legacy systems. We keep coming back to this. Many banks are simply hobbled by monolithic, inflexible core banking systems that might be decades old. These systems are the primary source of those data silos we discussed. They are incredibly expensive and complex to maintain. And critically, they significantly hinder the integration of modern tools like APIs and AI platforms that are absolutely essential for competing effectively today. Now, while a full rip-and-replace modernization of a core banking system is a daunting, high-risk, multi-year, extremely expensive endeavor that many banks are hesitant to undertake.
Yeah, that sounds terrifying for a bank CEO.
It is. But progress can be made incrementally. Banks don't have to do it all at once. Strategies like implementing an API abstraction layer over the top of legacy systems to expose their data in a more usable format, or adopting an event-driven architecture to enable real-time data flows between old and new systems. These kinds of approaches can provide significant value relatively quickly without the massive risk of a single big bang core replacement project.
Okay, so tackle the legacy beast piece by piece. What's next?
Second, and arguably just as critical, is establishing robust data governance. As we've consistently shown throughout this discussion, a lack of strong, enterprise-wide data governance is perhaps the primary cause of failure for ambitious data and analytics initiatives in banking. Banks simply must establish a formal governance framework. This needs to include clear, enforced policies for data quality, data security, data lineage, metadata management, and data access controls. But it's not just about policies and tools, it's also about fostering a culture where data is consistently treated as a valuable, shared enterprise asset, not as the private property of individual departments or product lines. Foundational tools here include building a comprehensive data catalog, like a library card catalog for all the bank's data, making it discoverable and understandable, and defining a clear, common business glossary or dictionary of key metrics and KPIs to ensure everyone is speaking the same language and measuring things consistently across the organization.
Getting everyone on the same page about what the data means.
Essential. And third, a persistent challenge, particularly for regional banks that might not have the same resources or brand pull as the giant money center banks, is bridging the talent and knowledge gap. There's a real struggle across the industry to attract and, just as importantly, retain talent with the necessary skills in areas like data science, advanced analytics, AI engineering, and modern data architecture. The solution here really has to be twofold. First, a genuine, sustained commitment from leadership to upskilling the existing workforce. Banks need to foster data literacy at all levels of the organization, not just in specialized teams. And second, they need to be pragmatic and embrace strategic partnerships. Collaborating with fintech companies, move to cloud providers who offer many sophisticated data tools, and specialized data and analytics consulting firms can be crucial for accelerating progress and importing critical expertise where it's lacking internally. You can't always build everything yourself. #B. Quantifying the return on data investment. ROI.
This all sounds incredibly powerful, strategically necessary even. But for bank leadership, especially the board of directors, it often boils down to one crucial question. How do you actually quantify the return on investment, the ROI, for these often significant data initiatives? You need to be able to frame these projects in terms of tangible business value to secure that crucial C-suite support and ultimately the funding needed to make them happen. How do you build that compelling business case?
It's an excellent question, and it's absolutely essential for getting buy-in and sustaining momentum. Building a credible ROI calculation for data initiatives must begin with defining clear, specific, and measurable business goals upfront. You can't just have vague aspirations like getting more efficient or improving customer experience. That won't cut it. Well-defined objectives need to be concrete. For example, our goal is to reduce loan loss provisions by 15% within 2 years through the implementation of this predictive credit modeling system. Or, we aim to increase cross-sell of high-yield savings accounts by 20% among this target customer segment via personalized marketing campaigns driven by our new analytics platform. Or even, we project we can reduce average call center handle time by 25% within 12 months by deploying this AI-powered agent assist tool. Those are specific and measurable.
Okay, start with clear targets. Then what?
Then, you need to conduct a holistic cost-benefit analysis, being realistic on both sides of the equation. For the investment side, the denominator in the ROI calculation, this must include not only the obvious costs of software licenses and hardware. It also has to account for infrastructure upgrades, data acquisition or licensing costs if using external data, and critically, the often underestimated soft costs associated with labor, both internal staff time and external consultants, comprehensive employee training, and the significant change management effort required for successful adoption across the organization. Underestimating these implementation costs is a common mistake.
Right, it's not just buying the software.
Not at all. Then, for the return side of the numerator, the benefits calculation must try to quantify both the tangible, easily measurable gains and ideally assign some value to the more intangible benefits as well. Tangible gains are things like directly increased revenue from better cross-selling or new product adoption, clear cost savings from operational efficiencies like reduced manual work or lower call volumes, or reduced losses from improved fraud detection or lower credit defaults. Intangible value is harder to pin down, but still important. This includes things like faster, more informed decision-making across the bank, an improved compliance posture which reduces regulatory risk and potential fines, or enhanced customer trust and loyalty stemming from better, more personalized experiences. We saw that example earlier. A European bank implemented advanced analytics specifically for credit card marketing. They saw a 5-fold increase in the uptake rate of their offers compared to previous campaigns, which directly generated tens of millions of euros in new measurable revenue. That's the kind of clear financial impact that gets attention.
That definitely makes the case. Now, this sounds like a journey, doesn't it? Not a single leap from zero to data nirvana. It's more like moving through different stages of maturity over time.
That's a very good way to think about it.
Mm.
It's definitely an evolutionary process.
We can almost think of it as a phased data analytics maturity model, right? Maybe you start in stage 1, siloed and reactive. Here, data is disparate, stuck in different systems. Analysis is often done manually in Excel. Reporting is static, looking backwards, basically just telling you what happened last month or last quarter. And operational costs for data handling are probably quite high.
That's the starting point for many, yes. Basic reporting.
Then maybe you move to stage 2, centralized and reporting. Here, you've likely invested in a data warehouse or a similar central repository. This enables more automated reporting, maybe some standard dashboards with consistent key performance indicators, KPIs. You get better operational efficiency in reporting, a clearer view of what happened, but it's still mostly historical.
Progress, but still descriptive analytics.
From there, you aim for stage 3, predictive and proactive. Now you're likely using cloud-based data platforms, maybe a lakehouse architecture, integrating many more internal and external data sources. This allows you to build predictive models using machine learning. You get those early warning systems for risk. You can forecast what will likely happen, leading to proactive risk mitigation and more timely, personalized customer offers.
Moving from hindsight to foresight, a big step.
And finally, perhaps the pinnacle, stage 4, prescriptive and automated. Here, you have fully integrated AI and ML platforms, maybe real-time data streaming capabilities. This enables not just prediction, but prescriptive analytics models that can suggest what should be done in a given situation. You might be heavily using Gen AI for content creation and decision support. You can deliver hyper-personalization at scale, automate complex decisions within defined guardrails, and potentially unlock entirely new data-driven revenue streams.
That's the aspirational state, where data truly drives automated intelligent action across the enterprise. It's a journey, as you said, and banks need to understand where they are and realistically plot their path forward. Hashtag C. Final recommendations for regional bank leadership. So if we were to synthesize all of this discussion into some core actionable advice specifically for the leadership teams, the C-suite, and the board of regional banks, what would the key takeaways be? First, and perhaps most importantly, they need to elevate data strategy to a C-suite imperative. This cannot be delegated solely to the IT department or a mid-level analytics team anymore. The board should actively champion this, perhaps by supporting the appointment of a chief data officer, CDO, or an equivalent senior executive leader. This role needs real authority, budget, and resources to drive an enterprise-wide data strategy, break down those stubborn organizational silos, and foster a truly data-driven culture starting from the very top down.
Leadership buy-in is crucial.
Absolutely paramount. Second, leadership must fund data governance as a strategic enabler, not just a cost. They need to shift their mindset and recognize that investments in data quality initiatives, modern data architecture, and robust governance frameworks are not mere compliance costs or overhead. They are the essential prerequisites, the foundational investments that truly unlock the business value of all other technology spending and strategic initiatives across the bank. Cut corners on governance, and you jeopardize everything else.
So invest in the foundation before building the skyscraper.
Precisely. Third, they should adopt a phased, use case-driven approach to implementation. Avoid trying to boil the ocean with massive, all-encompassing transformation programs that often fail under their own weight. Instead, prioritize specific data and analytics initiatives based on clear, demonstrable ROI potential and alignment with strategic business goals. Start with some quick wins projects that solve specific, high-impact business problems relatively quickly. This helps build momentum, demonstrates immediate value, and secures organizational buy-in for more ambitious, longer-term projects down the road.
Build credibility step by step.
Yes. Fourth, embrace strategic partnerships. Bank leadership needs to acknowledge that building all the necessary data and AI capabilities entirely in-house is likely neither feasible nor efficient in today's rapidly evolving technology landscape. They should actively seek out and collaborate with strategic partners, major cloud providers, innovative fintech companies, specialized data consultants to accelerate their modernization efforts, import critical skills they may lack internally, and leverage best-of-breed technology solutions rather than trying to reinvent every wheel.
Don't go it alone.
It's usually faster and more effective not to. And finally, perhaps underpinning all of this, they must cultivate a data-literate culture throughout the entire organization. The most advanced technology platform in the world is ultimately useless if the employees do not trust the data, don't understand the analytics, or simply don't know how to use the tools effectively in their daily work. Banks need to invest in continuous training programs to improve data literacy across all departments and empower employees at all levels, from frontline tellers to senior managers, with the self-service tools, the knowledge, and the confidence needed to use data to make better, faster, more informed decisions every day. #outtry.
Wow, what an incredible deep dive that was. It's crystal clear, listening to all this, that data is no longer just some background commodity. It truly is becoming the new currency, fundamentally reshaping the future of commercial regional banking, and consequently our interactions with our banks in really profound ways. This whole shift you described, from thinking of data as the new oil to understanding it as a new currency, it feels fundamental. It requires banks to really embrace data intelligence across all their operations, from revolutionizing those customer relationships and fortifying their risk management practices, to streamlining the compliance burden and even venturing onto the bleeding edge with generative AI. It really does feel like a future built on bytes, not just bricks and mortar.
Absolutely. And perhaps a final provocative thought for you, the listener, as you absorb all of this information. Start considering what this significant shift really means for your relationship with your own bank moving forward. As your financial data genuinely becomes this powerful medium of exchange, this currency, are you prepared to understand its inherent value? Are you ready to choose wisely how, where, and with whom you spend or share that data currency? And maybe most excitingly, what new opportunities might this emerging power over your own data unlock for improving your personal financial well-being in the future? It's definitely a question worth pondering as we all navigate this increasingly data-rich financial future together.
That's a fantastic thought to end on. Thank you so much for joining us today on this deep dive. We hope you, our listeners, feel much more informed and ready to navigate this fascinating, complex, and rapidly evolving landscape where data truly is king. We'll be back soon with another deep dive. taking you into the heart of complex topics and making them simple. Thanks for listening.